All right. So let's start with, I have some notes here. Let's start with the metal. As you know, in January, February, thought, the gold and silver got too far ahead. Sell your bullion. I got a lot of negative comments. I got a lot of, you don't know what you're talking about, Grandich. But played into what I felt was a needed corrective. Yesterday, I talked about we've now come to the point, I reemphasized it at first thing this morning, that I thought gold corrected enough that we can look at it again. And at the same time, shares have come off, even some of the majors are 20, 30, 40% off from their highs. But I don't think the story has changed. But this isn't the Peter Grandish story. This is the Michael Gentile. What do you think? So let's start with your general macro view, even if that means you put on a little bit of your money management hat. And then, of course, we'll go to your individual companies and all where you invest for yourself.
Yeah, I mean, since we're doing this once a month, Peter, and I assume at this point most of your viewers are subscribers to my newsletter. That's SaturdayMorningMining.com is the website if you want to get it for free every Saturday. Um, 2 weeks ago, I wrote a short novel, Peter, on my macro thesis for gold because the gold price was down and people were hemming and hawing, complaining. And I always say, check your basis, check your macro basis, and I'll summarize really quickly about 4 pages that I wrote in like 2 minutes here, but. I got long gold, Peter, in 2015, professionally, 2018 as a private investor in junior mining because of my view that the deficits in the US were out of control and that monetization of the debt, money printing, whatever you want to call it, was going to come fast and furious towards us. Since then, it's blown past my wildest fears or dreams, depending on which side of the trade you're on in terms of as a US taxpayer versus a owner of gold. But COVID happened, Russian war happened, Iranian war happened. When Barack Obama took office, Peter, there's $8 trillion of debt in the US. Today we're at $39 trillion of debt, tacking on about $1 trillion every 6 months. So just to keep simple numbers, by the end of this year, the US will have 40 trillion or more of debt on the balance sheet. Fiscal year ending September 2025, the US took in just a bit more than 5 trillion US in revenue. If you take 40 trillion of debt and you take the 10-year yield, which is about 4.5, and the 30-year yield, which is about 5%, Peter, just assume 5% to keep the numbers simple as your average borrowing cost in the US as a borrower of $40 trillion. That's $2 trillion a year of interest expense on the government debt. That's just the interest expense. You're not paying it back. The US government ran a $1.7 trillion deficit fiscal year 2025, September. There's only $800 billion of interest in that number. So if you follow my math, you're going about $1 billion more of interest expense because the rates are higher. So now you're at, 2.7 to $3 trillion a year of interest expense of deficits in the US. And Donald Trump is asking for $500 billion a year more for defense on top of his previous spending. So very easy to see $3 trillion deficits in the future in the US going forward at current interest rates. That $2 trillion a year of interest expense, Peter, is 40% of their revenues. Now, if you went to Mary and said to your beautiful wife and said, Mary, we're spending 40% of my revenue every year on the interest on our credit card, the Grandich household will be insolvent very, very quickly. That's the undisputable facts about the US fiscal situation. And so people are saying, oh, inflation's picking up, rates have to go higher. I'm here to say, I don't care what the Fed says, rates can't go higher. And if they do go higher, inflation has to be 15% to offset it because the US cannot afford their current fiscal situation. So you're going to have yield curve control. You're going to have negative real rates, whatever you want to call it, Peter. The math doesn't lie. And nothing of the gyrations in the short term that I've seen can stop that train from getting to the station. And so that's why I said, I agree with you, Peter, that the pullback in metals is healthy. It was a bit too far, too fast. It was too much speculative money kind of flowing in on a very short notice. But the long-term macro thesis has never been more robust. And I see a continued strong tailwind for gold, which is why I invested heavily in Cambria 4 months ago and why I made a massive new investment today in a new company, Peter, which I'm pretty sure we'll talk about in a few minutes, McFarland Lake. If I'm deploying capital in the gold space today, it's because I believe 5 to 10 years from now, that's my horizon when I make an investment, Peter, is the gold price going to be significantly higher 5 to 10 years from now. So I'm still deploying big checks in the gold space. That tells you my views remain intact, and the numbers in that newsletter I think are indisputably hard to refute. And that's why I think we're going to see more and more money printing and therefore a higher gold price over time. Or de facto, a lower US dollar really is what you're going to see, lower paper currency value, but gold will go up because of that.
The only thing I'm afraid to go to Mary Grange about is I want to buy more junior resource stocks. All right, listen, you just mentioned